questions on PPE. PPE questions are always tested, and because the reason why they always test it is because it is one major challenge in practice. I was in a firm for 2 years practicing in a firm of chartered accountants. And from experience, I know that people have issues treating items, they have challenges treating issues on property, plant, and equipment. It's always difficult for some. And I've met even people who are fellow chartered accountants. See, one thing is to qualify as a chartered accountant. Another thing entirely is to acquire relevant experience. When you acquire relevant experience and you see how these things are treated, because this is theory we're learning, it's an exam we are preparing for. There's another thing to enter into a firm and then where the thing is actually practiced. When you now see what you have learned in theory demonstrated in practical, it stays with you. But one of the challenges that I know people have is when they qualify, they don't want to experience going through firm, because firm don't pay as much like that. Firm is just like a carpenter's workshop. You walk into, you say you want to learn. Ordinarily, they are not supposed to pay. You are the one that's supposed to pay the carpenter man if you want to learn carpentry. But they give token. So because money is not there like that, people don't want to go and learn. They go to get a job with their certificate, and they can just keep them at one petty department doing some miscellaneous job like reconciliations, looking at payroll. They will not do the complex task for a chartered accountant, which has to do with corporate reporting, financial reporting. As a result, they have issues dealing with items of PPE. And usually, when you look through the financial statement, you see huge amount of money on property, plant, and equipment. So it is sure that ICANN will test it, because those who set the questions also are in practice, but they know the challenges they face. Most of the questions they bring up are the things they are actually facing, that some of them are faced where they are actually working. They bring them practical questions, they bring them to it. So that's why we take a lot of time on PPE, so that when you see the question, of course, they may not bring the question on PPE as a question on its own. They may group it among maybe the group account, they put the question there, or they just bring some questions together and they will put PPE challenges inside it. But you can be sure that issues that has to do with property, plant, and equipment will be addressed. That's one thing. So I hope you can see my screen. Please, if you can, just say yes. But see if you can see this the recognition of property, plant, and equipment. Put on the screen. If you can see it, let me just see. Say yes in the chat box so we can continue. Thank you very much. See yes. So we began by, I've put the notes for the first 3 classes we had on IS 16 in the group chat there, the class, so that you can read through it if you didn't write much notes. And as you watch the video, you'll be seeing you can even make notes watching the video. Since you can pause, you can rewind, rewind that they call it, take it backward, take it forward. That's the benefit of it. Watch it over and over again and make your notes from it. I also put the note there for you. So we're talking about the recognition of property, plant, and equipment. One thing is certain: items of PPE entered into the financial statement on a particular date. It is also sure that one day the item will leave the financial statement. And there are things that can actually happen. They can sell the asset can reach the end of its useful life, the asset might be given as exchange for another asset. But one way or the other, the asset will exit the financial statement. And so what is the procedure when an asset is to leave the financial statement? We know the procedure when the asset is to come into the financial statement for the first time. So we're now saying, what is the procedure when the asset will eventually leave the financial statement. So first talk about the gain or loss on disposal of non-current assets. So gain or loss on disposal of non-current assets. This is how it is computed. This is how it is computed. Maybe you can see the formula on the screen. You recognize the sales proceed. Then you say less cost to sell. Cost to sell the asset. You remove it from there. Say net disposal value is what you have after you have removed cost to sell. Then you take the asset at cost less accumulated depreciation. Then you have the carrying amount of the asset at disposal. When you take that out of the net disposal value, if your answer is positive, what you have is gain on disposal. If your answer is negative, what you have is loss on disposal. And there is a double entry treating that. That's the first thing we are learning this morning. So we are starting by taking the first example, gain or loss on disposal. Gain or loss on disposal of assets. That's the first thing we want to look at this morning. Gain or loss on disposal of assets. So you can see the question. A non-current asset cost 96,000 and was purchased on 1st June year 1. Its expected useful life was 5 years and its expected residual value was 16,000. The asset is depreciated by the straight line method. The asset was sold on 1st September year 3 for 68,000. There were no disposal costs. It is the company policy to charge depreciation on a monthly basis. The financial year runs from 1st January to 31st December. What was the gain or loss on disposal? So we are going to be using our Excel sheet as usual to work out this challenge. So first, which is our first example, as usual, we call it example 1 this morning. Example 1. Example 1. This is our example 1. What are we going to be addressing? We want to be addressing gain and loss on disposal of assets. Gain, loss, gain, loss, or loss on disposal of assets. That's the issue we want to be looking at this morning. Gain and loss on disposal of assets. So now in this issue, in this question we have, the first thing we need to first do is to know how much of the asset has been depreciated over its life to the point that it was sold. So we start by taking the asset at cost. So we take the cost of the asset at cost. Yes. Asset at cost. When it was previously initially purchased, it was 96,000. 96,000 naira when they purchased the asset at first. Then we will need to know how to compute the depreciation. We take out the residual value of the asset. Residual value of the asset. According to the question, they said it has a residual value of 16,000. 16,000. So we put the 16,000 there in brackets just to show that it's going to be deducted in this formula. So we want to know the depreciable amount of the asset. Depreciable amount. Depreciable amount of the asset is going to be the difference between these two, which is 80,000. That's the depreciable amount of the asset, 80,000. Now, we are told that it is depreciated on a straight line basis, on a straight line method, it was depreciated. And so, we want to know the depreciation charge for year one. Don't forget, it is the company policy to charge depreciation on a monthly basis. And this asset was bought on 1st June, year one. 1st June, year one. In year one, it means the asset was used for 7 months because it's 1st of June. Please, we need to be smart at discovering this in examination. June, when we see June, we can be quick to say 6 months, 6 months. No, look at the date, 1st June. It means it was between 1st of June to December that the asset was used. So 5 months were already gone, that's January to May. But from the 1st June to December, it is 7 months that the asset was used. So we first have to, the first thing is how many useful life is the life of the asset? Say the asset has a useful life. Okay, it's expected. So its expected useful life is 5 years. So first, let's take that one. Useful life. Useful life of the asset is 5 years. 5 years. 5 years. So normally annual depreciation should be the difference. So annual depreciation. Annual depreciation should be the division of this and this. So it equals to 80,000 divided by 5. Our annual depreciation is 16,000. However, in year one, so depreciation, okay, depreciation is depreciation schedule. Let me put it there, depreciation. Depreciation. Depreciation is what we want to calculate now for each year. So I pick year one. Year one. Depreciation for year one is going to be that 16,000 times 16,000 times the number of months, 7, then divided by 12, which is the number of months. That's the rate at which depreciation will be charged in year one, times the 7 months that it was used, divided by 12. So if we want to do that, we say equals 16,000 times 7 divided by 12. And so depreciation in year one is 9,333 naira 33 kobo. Then we go to year two. When was it disposed? The asset was sold on 1st September year 3. So year two has full year depreciation. So year two we just take its full year depreciation. Year two we take 16,000 naira, which is the full year depreciation year two. In year three, so for year 3, how many months was the asset used? The asset was sold on 1st September, year 3. So it was used only for 8 months, January to August, because the first day of September was when they sold it. So we are going to prorate that one as well. It's going to be 16,000 times the 8 months divided by 12. That's going to be how to compute it. So we say equals 16 times 8 divided by 12. And so we have depreciation for the year of. So let me run them up to the nearest. Seamless. So accumulated depreciation over the life of the asset. Accumulated depreciation over the life of asset is the sum of these three. The sum of these three, which is 36,000. naira. That's the accumulated depreciation over the life of the asset. Therefore, now that we know the accumulated depreciation, we will go back to the formula that we learned on how to calculate gain or loss on disposal of assets. The question told us that it was sold for 68,000 and there was no disposal cost. So first we are going to have this schedule. The schedule says first we will have sales proceed. If there is disposal cost, we deduct it to know the net disposal value. In this case, there is no disposal cost. So we take sales proceed and then we go on to carry the cost less accumulated depreciation. And then then we go on to do that. So let's quickly do this one. So gain on loss, so we call it computation of gain or loss. Computation of gain or loss on disposal. Computation of gain or loss on disposal. That's what we want to do now. How do we compute that? So we're going to be bringing in the formula that we had. So the first thing we are doing, put another sign here. First thing we are doing is to discover the sales proceed. And the sales proceed, according to the question, the sales proceed is 68,000. So 68,000. That's the sales proceed. That's the sales proceed on the asset. Then, since there is no cost to sell, since there is no cost, disposal cost, so the next thing is to calculate the asset at cost. Asset at cost. The asset at cost that we already have is 96,000. 96,000 is the asset at cost. Then less accumulated depreciation. That's accumulated depreciation. Accumulated depreciation, and that one is what we have here. We're going to put that in jacket at 6,000. That's the accumulated depreciation. So carrying amount at disposal. Carrying amount at disposal. We're going to put the figure somewhere here for ease of computation. Sorry, I'm going to try and extend this so that we have a place. For ease of computation, we have it here, the difference between these two. This is what we are going to be putting there. Okay, sorry, let me just do it properly. This. So this is a carrying amount at disposal, which will also be in jacket. Carrying amount at disposal, because we have to take it out of these assets. We have to take it out of the cost of the asset, the disposal proceed. So gain or loss on disposal. Gain or loss on disposal. Gain and loss on disposal is the difference between these two. 68,000 and not 60,000. Sorry, 68,000 minus 60,000. We have 8,000. That's gain or loss on disposal. That's how to calculate it. That's how to calculate gain or loss on disposal. Then the next thing we need to know is how to post it into the account. Because it's not just, we can do the computation just like we have done it, but you can see how we went through the computation so straightforward. First, determining what the accumulated depreciation is, so that we can know the carrying amount at disposal. we take that out of the disposal proceeds, and then we're able to arrive at gain, because the answer is positive, it's gain. If it is negative, it's going to be loss on disposal. So the task we need now is, how do we account for it? Accounting for the disposal of property, plant, and equipment. How do we treat it? That's where many accountants have challenges in preparing financial statements, not knowing how to account for gain or loss on disposal in the financial statement. So I want you to pay attention as we look at it together now. So there are various steps in treating it. These are the things we put. I'm trying to bold in some of them. See them clearly. There are various steps. In general ledger, the gain or loss on disposal of a non-current asset is recorded in the disposal of asset account. The double entry transactions required as follows. For an asset recorded at cost rather than at a revalued amount, step 1, transfer the cost of the non-current asset from the asset account to the disposal account. Step 2, transfer the accumulated depreciation on the asset from the accumulated depreciation account to the disposal account. Step 3, record the cost of disposal in the disposal account. Then record the sales proceeds in the disposal account. Step 5, the balance in the disposal account is the gain or loss on disposal. This is transferred to the statement of profit or loss. Now we can see how it has been explained, but it is more important that we see how it is done in practice, so that we will be able to appreciate how it will be done. So the concept here is, once an asset is disposed, every information relating to that asset will be withdrawn from various sources where it was previously. If the asset, so we're going to the asset at cost, we pull the asset out. We go to the accumulated depreciation. Historically, we pull it out. Everything comes to the disposal account. The cost of disposal also comes to the disposal account. And then we net everything off in the ledger. So we will do the double entry, and then we will do the account, so as for us to be able to appreciate that. So we're going to be taking an example to treat that. We can as well use this example so that we can further analyze, and then we can just portray this with this example. So let's go here. The first step is to transfer the cost of non-current asset from the asset account to the disposal account. So I'll come here and say the double entry for disposal. Still under here, double entry for disposal. Double entry for disposal of assets. Double entry for disposal of assets. Double entry for disposal of assets. So we will be doing that here. So the first thing, so I have here debits, the second one credit. The first thing is to withdraw the asset from the asset register. So the first thing is debit disposal account, disposal account, debit disposal account, credit asset account, credit PPE. That's the first journal. So what is the cost? If we are taking the cost out of the disposal account from the asset register, and then we credit PPE. When we credit PPE, what we have done is we have taken this asset out of the asset register, and we have put the cost, historical cost of the asset in the disposal account. And the explanation will be what? Being the cost of the assets disposed. That's the journal, the first journal. Being the cost of the assets disposed. The second journal, so let me number the journal. This is 1. So the second journal, journal 2, is to go to the accumulated depreciation account and pull out the information relating to this asset there. So we say debit accumulated depreciation account, accumulated depreciation account, and with how much? So let me put that to page. So debit accumulated depreciation, and with how much? With the amount of accumulated depreciation, 36,000, and we credit disposal account with this amount, 36,000, with 36,000, and it will be explained as being the accumulated, being the transfer of accumulated depreciation to the disposal account. Being the transfer of accumulated depreciation to the disposal account. So that's the description for this journal. That's the description for this journal. That's the description for this second journal. And so the third journal, journal 3, is to now, if there is cost to sell, we will have to debit that also to the disposal account and credit the relevant line. If it is paid by cash, credit bank. If it is on credit, that cost we incur to sell. If it's on credit, we credit payable. So let me just put that here, although it does not apply in this example, but let me put the journal so you see how we do. So for cost to sell, we debit disposal account. For cost to sell, we debit disposal account. In this case, it is 0 because there is no cost to sell, and credit the relevant account, credit bank, can be bank or payable. If we have not paid that cost to sell, though in this case it is 0. So the explanation for the journal will be being the cost incurred to dispose the asset. That's it. But it is 0 in this case. 0. This is our example. So we go on to journal 4. In the journal 4 is where we put the proceed of the asset, the proceed that we receive from selling the asset. We are going to be putting it here. If we have received the money, it goes to bank, we debit bank. If we have not, we debit receivable. Debit receivable account with the amount that we receive. How much was it? 68,000. It is the cash received. And credit disposal account with the same 68,000. And so those are the journals we have to pass in respect of this transaction. Those are the journals we have to pass in respect of this transaction. So I will be passing the journals now. We'll have the T ledger as usual. So let's say we are using this place as the ledger. The ledger. Okay. Description will be here. There will be here. So let's now say the disposal account. We want to open a ledger called disposal account. Disposal account. For the disposal account ledger, we are going to be having debit credit here. Debit credit. And so we have another ledger for asset account. Asset account. The asset account. Let me put that one somewhere here. I hope the transaction does not go. Asset account, which was in existence before. Asset account is a ledger. Then we have another ledger, which is going to be for the accumulated depreciation. Accumulated depreciation. Accumulated depreciation account. Now, those are the ledgers we have as far as this example is concerned. If we have more, we open more. So in the disposal account, the first journal we pass that affected it is that we should debit it with what? 96,000 naira. So we come here and say asset. Remember how we used to pass ledger. Why am I calling it asset? Because the second leg of this transaction will be going to asset. So asset, put the figure of the asset at cost, which is worth 96,000. Then the second journal, and then when we do that, the corresponding credit leg goes to asset. Asset that previously assets, let me just call it PPE, that previously has a debit balance of at cost of this amount. Debit balance at cost of this amount will now be credited. Will now be credited, say disposal account. That's where the second leg is. Because initially, don't forget that the asset has a debit balance and it's in the balance sheet. It's in the asset register, it's a debit figure there. So in disposal, now we dispose it of, we have taken it. Is this one we are treating now? When the asset was purchased initially, you debit the asset and credit bank if you have paid, or you debit the asset and credit payable if you have not paid. That was when it was initially recognized. We are not treating that here now because we are assuming that they have done that in the past. We are just looking at when the asset is disposed. That's what we are dealing with under this circumstance, when the asset is disposed. Now, we have done the first journal here, debiting disposal account and crediting. Then we go to second journal. We debit the accumulated depreciation account. Don't forget that accumulated depreciation account previously was also having a credit balance. So we can just say balance brought forward, which is what we have in the asset accumulation account. Is always a credit balance. It was there. This 36,000 was already here. But then we are passing the journal into a disposal account. Disposal. We want to debit accumulated depreciation, just like we said, debit accumulated depreciation account with 36,000 and credit the disposal account with the same 36,000. So we say accumulated depreciation. Accumulated depreciation. Credit it with what? 36,000, which is this amount we have here. Don't forget that's the second journal. Debit accumulated depreciation, credit disposal account. Credit disposal account. Debit accumulated depreciation, credit disposal account. The third journal, that one we don't have, but let's just put it there so that you see how it will look like. We are treating the cost to dispose. That's cost to dispose. Cost to dispose the asset. Cost to dispose the asset. So we say debit disposal account, credit payable, or credit bank. But we don't have that here. Don't forget, if it's there, we'll have to pass the journal here too. I don't want to be doing a repetition of that. So the last one is we take the value of the asset, we debit bank and credit our receivable and credit disposal account. So let's have a receivable account. Let me put it somewhere here. Receivable account. Receivable account. Receivable account. Receivable account. Once we have the receivable account, the instruction says was we should debit it and credit disposal account. So inside the receivable account, we put in the description of disposal account. That's where the second leg is coming from. And what we are going to be doing now is to debit it. Let me put the debit credit there so that there's no confusion. Debit credit. So we debit it with how much? According to the question, debit with 68,000. So we debit the receivable account with 68,000 naira, which is the amount we received from disposal, and then we come to credit this disposal account with receivable. Don't forget, we are calling it receivable because that's where the second leg is coming from. Receivable, and credit it with how much? 68,000 naira. 68,000. Those are the journals. They are supposed to be 4. We are able to pass 3 because the third one does not exist. So this account has a debit of 96, a credit of 96. Therefore, at the end of the day, the account is balanced, meaning that it has been nailed up to 0. It has been nailed up to 0. That's it. There's no balance remaining on this account. I know you understand exactly what I'm talking about because nothing remains there in the account. So that's asset account. Let me just put it in its own box, in a separate box, asset account. Then the disposal account, we are going to be checking if there is going to be a balance in the disposal account. Sorry. If there's going to be a balance in the disposal account. Let's check. This side has 96, and this side, how many? Let me add this together first. Add this side together, we have 104. And then when I add this side together, of course, this one must also be 104. Don't forget our balance account. This one also will be 104. Then what's going to be the difference between this and this? The 104. What's going to be the difference between the 104 and 96? So we come here and say, check if it is positive or negative first. That is 104 minus 96. So it's positive. That becomes gain disposal. Gain on disposal. So it is 8,000. That was what we put previously. So we also put this one in its own box so that we can see exactly what we have done for the disposal account. And then for this bank, okay, this is journal, disposal account, asset account, then accumulated depreciation account that previously had this and this. If we total it so that they are the same figure, so the account also has gone to 0. The account has gone to 0. I know what I'm talking about because when I was in a firm, we went to audit a company. It's a health insurance company. They disposed an asset, and the accountant went to put the accumulated depreciation, which had a credit balance, inside retained earnings. All of us were just laughing. Although he is still trying to qualify, but he has not been practicing. And he probably has learned this in theory, but does not know how it operates in practical. You see, he went and put it under retained earnings. went and put it under retained earnings, something that's supposed to be written off and treated in the disposal account, so that we will know that we have closed the asset account, we have closed the accumulated depreciation account, and the disposal account will tell us what remains in respect of that account. Now, this gain or loss on disposal is taken to profit or loss account, profit or loss account, P or L. Let me say P or sorry, P or L. That's where we must take this gain on disposal to. I want to believe you understood exactly what we have done here. Or if you have a question, can you please quickly put it in the chat box so that I'll be able to see the question and attend to the question as appropriate. Attend to the question as appropriate. That's how to do the accounting. That's how the first is how to determine what exactly we have done, and the second one will be how to treat the assignment. If you don't have questions, say no question. You can say no question. You can just do thumbs up. Then we go on to the next thing to do and beat time. Okay, no question. It is a response. The others. What is here? Okay, just the two of us. So we rest, still sleeping. Okay, you can always watch the video. You can always watch. Okay, sir. What about the second leg of receivable account? Thank you. The receivable account, we have a balance. The second leg is here. Maybe you just want me to balance the account. There's no credit. There's only one balance. It will have the balance will remain here. So it is from here that we are going to take it to the balance sheet as our receivable for the year. It has a balance. So the information that has closing balances, asset does not have closing balance, so it does not go anywhere. Accumulated division does not have closing balance, does not go anywhere. Receivable has a closing balance of 68,000. So if the money is not received yet, it remains as trade receivable in the balance sheet. And the disposal account has a balance of 8,000, which is going to be taken to the statement of profit or loss. So these two will carry their balances. This one will carry its own balance, 68,000, to balance sheet, while this one will carry its own balance, 8,000, to the statement of profit or loss. These are the two accounts that have balances at the end of these transactions. They are the two accounts that have balances at the end of this transaction. So I hope you get it now, and can just do thumbs up if you understand. So it does not have second leg. The second leg is in the disposal account. What we did is to debit it and credit disposal account. We have done the double entry. It only has closing balance, and that closing balance goes to the balance sheet. Thank you very much. So let's move on. We have done all these. So we go to the next one. Okay, this example. Okay, what I will do is let me put this in the on the wall as an assignment that I want you to do. Now, don't be confused by the figures you are seeing. Okay, now current asset cost is 2,000, but I want to purchase, it was shown the 2,000 when the accumulation was this. Okay, they didn't tell us here, but they have given us the figure of accumulation and they have given us the disposal cost required. Show the bookkeeping entries. This is exactly what they want you to do. So I'm going to put this question there for you as an assignment, and then you will do it, and then maybe later in the day put it on the chat box. Let me quickly do that. So that we can proceed. I want to quickly do that. Let me cut it and put it in the chat box. Let me now call it example this time. Let me not call it example. Let me call it assignment. So I want to put it there for us to see. There for us to see. Sorry. So put this in the chat box for us. From there, we be able to see it, access it, and then deal with it. Assignment. I'll put it there for us in the chat box. Assignment. Later in the day, you do it and then you give it to the assignment. So it's there, the chart, after you treat it, after the class. So now let's go to the next issue. This one is talking about when we have multiple assets. We can be confusing sometimes. Although the multiple we're talking about is one classified. Don't worry, when we get to presentation of financial statements, I'll be showing you how the note to PPE should look like. So that when they give you question in the exam, how you can quickly prepare the notes. We are going to get there on how to present. When we are looking at compliance, that is published account, how we do audited financial statement. That's what they expect you to prepare an examination, statement of profit or loss, balance sheet, statement of changes in equity, statement of cash flow, statement of value added, and then notes to the account. Those are the things they expect you. I will show you how that is done in the course of our training. But this is just one item, one class of asset, but it's not just one. It said a business has entered into the following transactions involving plant and machinery over the last 3 years. So on 1st January 20X1, 1st January 20X1, he bought several items of plant and equipment for 800,000. 800,000. On 3rd June 20X5, he bought several items of plant and equipment for 500,000. 500,000. On 28th February 20X6, he bought several items. 28th February 20X6, he bought several items of plant and equipment for 240,000. 240,000. 31st March 20X1, he sold some of the items which it had purchased on 1st January 20X4. These items had cost 300,000. The company depreciates assets using 20% reducing balance for depreciation. Required account for the depreciation for the year 20X6. That to show how depreciation for year 20X6 should be computed. This can be a little bit complicated, but we will do it as an example now. We will see how that over the years the asset has its own computation. So we are actually going to do what? Compute the depreciation for the year 20X6. But then we have to treat the depreciation for each year separately. So I'm going to have it as example 2. Example 2 here. Example 2. Example 2. Example 2. So this is the example 2. Example 2. And what we are doing is computation of depreciation for multiple assets. Computation of depreciation for multiple assets. So what I'm doing now, computation of depreciation for multiple assets. So now we are going to be having the years. There are how many years? 20x4, 20x5, 20x6. They are the years involved in this transaction. So our table, we have those years: 20x4, 20x4, 20x5, 20x5, 20x6, 20x6. That's what our table we have. That's what our table we have: 20x4, 20x5, 20x6. So we have it there that way. So let me put the Naira sign there. So it shows exactly that we're doing computation that has to do with money. Now, depreciation is what we want to do. So for the asset in 20x4, January 20x4, bought several items of plant and equipment for 800,000. Now, what will make this question a little bit look complex because of the method of depreciation used, which is reducing balance. Straight line method is just simple and just spread it over the years. But reducing balance has a system of computation that has to be done gradually. So for January 20x4, the asset bought on January 20x4. So I'll put dates here. Dates. So we have January 20x4. January 20x4. At least that's the date the asset was purchased. How much was the cost of the asset as at that day? The cost of the asset as at that day was 800,000. So the depreciation will be what? 800,000 times, what is the depreciation rate? Depreciation rate is 20%. So times 20%. That's the formula for computing depreciation in 20x4. But that was the only asset that was in existence as at that day. As at that day, that was the only asset that was in existence. So for 20x4, the depreciation will be what? Equals 800,000 times 20%. That's that will be 0.2. And so depreciation charge in 20x4 is what? 160,000. In 20x5, we are dealing with this asset first. In 20x5, depreciation will be what? 800,000. That's in respect of this asset. I'm not talking about division for all assets. We want to treat this asset over the 3 years. Then we'll treat the one for the second year over the 2 years and the one for the last one over the last year. Don't forget, we are going to compute the depreciation for this, although we can have the gross for everything. So in 20x5, we are going to be having 800,000 minus 160,000. Then we close the brackets and we say times 20%. Remember, that's the formula how to do reducing balance method of depreciation. That's going to be what we are going to have in 2005. So we put the formula there, equals, I can open the bracket and say 800,000 minus, 800,000 minus 160,000, close the bracket and say times 0.2, which is 20%. This is going to be the depreciation charge in year 20x5. In 20x5, this is going to be the depreciation charge in respect of these items purchased on January 20x4. We are dealing with the items separately. I will still do the one purchased later. I'm still working only on this one purchased in 20x4. That's what we are working on now. Only on the one purchased in 20x4. That's what I'm working on. So in 20x6, what do we compute in depreciation? The depreciation charge will be done for 20x6, and then we will have to prorate it to the percentage of the items sold and the ones not yet sold. So we said, the question said, if you look at the question, it said on March 31st March 20x6, sold some of the items which had been purchased on January 1st, 20x4. This item had a cost of 300,000. That is, items that cost 300,000 out of this 800,000 was sold on that day. So this is how to do it when you have that kind of question. The formula you want to do first is to calculate the depreciation for the items not sold and the one for the items sold, because items sold is only depreciated for, like, we'll look at the number of months. So we say 800,000 minus the accumulated depreciation is this 160 plus 128. That's what, let me quickly look at that on my calculator, the accumulated depreciation. Account has this amount. So accumulated depreciation will now be what? 160 plus 128, which is what? 288 minus 288,000. We close the bracket. I'm just putting the formula. It will now be times 300,000 divided by, sorry, let me just do the 500,000 times 500,000 divided by 800,000. I want you to look at what I have done. Okay, first, then I can now put times, another times 20%. 20%. Now, this is what I've done here. This 500,000 divided by 800,000, it is to prorate the percentage of what is sold. Now, this, what we are using here is the net book value as at that day. Don't forget, that's how to calculate reducing balance method. Cost minus accumulated depreciation, and what remains is what you charge your percentage on. So, okay, maybe let me put this 20% in the front. That is, multiply by 20% should be at the front first, so that we can see exactly why I've done what I've done. Now, 800 minus 280,000, that one gives us at 288,000. That's 800,000 minus 288,000. That one gives us 512,000. Please, you can be using your calculator over there. But why am I, okay, that should have been what I would just multiply by 20% if nothing was sold. It should just be 512,000 times 20%. That's if nothing was sold. But a percentage of these items were sold. That percentage is what? 300,000. The percentage that was not sold is worth 500,000 naira. So we are looking at what is a percentage of 800,000 is that 500,000 naira items that were not sold. So we are going to be having it calculated here for 20x6 for the items not sold. Items not sold. So we're going to be saying equals 512,000, which is what should be there, times the 20% at 0.2 times 500,000 divided by 800,000. We have the formula there. It is 64,000. Please use your calculator and do what I've just done. That's the depreciation for the items not sold. Now, we are going to do the one for the items sold. It also has depreciation. The formula for that one will be 800,000 This 800, this 800,000 minus 288,000, we close the bracket, times 20%, then times 300 over 800,000. 300,000 divided by 800,000. That's going to be the formula for this second depreciation. Please, if you are not getting it, you have the time to ask your question. Okay, this one I say 80,000, 50,000. No, this one should be 500,000 divided by 500,000 divided by 800,000. 800,000. The same thing with what we have here. That's what it should be. Okay, let me change the times here to the normal times I use for the other one, so that we exactly know exactly what we have done. That the depreciation charge for this second one, and that one will be here, equals, that's 512,000 times the 20%, then times the 300,000 divided by 800,000. That one we have what? The depreciation is what? 30. Okay, now this one is different. Please. This one was sold on what date? It was sold on 31st March. So this one will be depreciated only for 3 months. This portion that was sold will be depreciated only for 3 months, 3 over 12. So I need to still multiply this formula by 3 over 12. That has to be times 3 divided by 12. We have to prorate it to the items, number of items. So here, we're going to be having a formula 512,000 times 20%, that is 0.2, times 300 divided by 800,000, and we say times 3 divided by 12 again, 3 divided by 12. And so we have the formula there. It's going to be 99,600. That's the depreciation charge for that period. I'm coming. If you have questions, I'm still going to attend to the question, but let me quickly finish up. So for the items bought in 2005, that item was born on 30th June 2005. So we come here and say June 2005. June 2005. June 2005. The items that was bought is worth how much? 500,000 naira. So 500,000 naira, his own formula will be 500,000 naira times then 20%. 20%. That's going to be the formula. Then times again. Times how many months was it? Let me quickly check. How many months? It was 30th June. So that one is 6 months. 30th June. Times 6 divided by 12. Times 6 divided by 12. That's going to be the formula for the year 2005 depreciation. So it equals 500,000 times 20%. Hold on for me. 500,000 times 20%, then times 6 divided by 12. 6 divided by 12. That's going to be the depreciation charge for these items. Okay, coming 500,000 times 20%, that's 50,000 naira. Let me quickly check on my calculator if the information is right. 500,000 times 2 times 5. Yes, that's correct. And for the year 2006, was the depreciation, we are going to be having 500,000 500,000 minus the depreciation charge previously, 50,000. Then we close the bracket, we say times 20%, because we're going to be having full year's depreciation in 2005, 20%. That's the formula. And to put it here for 2006, I should say 2006. So we're having here 500,000, open the bracket, 500,000 minus 50,000. Then close the bracket and we say times 20%, 20%. That's it. We're having 90,000 here for 2020x, that's for 20x6 in respect of this item, 20x6 in respect of this item. So the next one will be to calculate the items purchased, the item purchased in February 20x6. We want to do the depreciation for that one. So we say February 20x6. February 20x6. What's the value of the item purchased? The item is 240,000 naira. So it's only depreciation is going to be 20x6. So 240,000 times 20% times how many months? It was bought in the end of February, so it's going to be for 10 months. Times 10 divided by 12. So under 20x6, put the formula 240,000 times 20% times 10 divided by 12. And so the formula gives us 40,000. That's how to calculate depreciation. So if we are looking at the total depreciation for each year. In 2005, the total depreciation is going to be this amount. That was in 2004, sorry, that was the only amount available. In 2000, and then I can just drag this, that helps me to do that very fast, so that I can just have my figure here. This is how the depreciation will be computed for the years over for the years of the asset. These are depreciation. So let me now listen to your questions if you have any question in the box on the computation I've done based on this depreciation. If you have any question, let me see your question. Put it in the box. If you have any question. And if you think there's no question based on this calculation I've done, let me know that you are okay, so we can move on. Look at it again. The question. This one, we calculate the depreciation over this asset in the first year. It takes a whole year. Or let me check. First year, it was January 1st that they bought it. So depreciation for the first year is a whole year depreciation for this one. Second year also is a whole year depreciation. It was in the third year that it was disposed. The bill for the part disposed is 64,000. Sorry, for the part not disposed is 4,000. For the part disposed, 9,600. And then we have for this one, it's going to be the figure of the depreciation charges that will be going to the financial statement for each year. Do you have any question? If there is no question, say no question, or just say no. There is question, ask. I'm waiting for you so that we can go. Hello, are you there? I'm waiting for you so that we can go on. I'm waiting so that we can go on. Okay, the submitter says no question. Okay, so David says no question. That means that part is clear enough for us. It's clear enough for us. Okay, Now we go on. The new standard, so that brings us to the end of the IAS 16, depreciation, disposal, the recognition. There's another standard I've been talking about, asset held for sale. That's IFRS 5. Assets held for sales and discontinued operation. We will be seeing that when it is time for us to see that. So we go to IAS 23, borrowing cost. It's a new standard, borrowing cost. When what we call borrowing costs are interest and other costs that an entity incurs in connection with the borrowing of funds. So when you go to Zenith Bank, you take a loan from them and they charge you interest. That interest is what is referred to as borrowing cost. Now, the concept of this standard is to let us know how to treat borrowing cost when it is when the money borrowed is invested on a qualifying asset. When we say qualifying asset, this second definition talks about what is a qualifying asset. A qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use. So if a company constructs its own asset and that asset takes substantial period of time to complete, for instance, a company is building a warehouse for itself. So they are building the warehouse and maybe it takes like 2 or 3 years before we can say that it's a substantial period of time. Of course, it means it's more than 1 year. Don't forget that 1 year in accounting is a short term. When it is more than 1 year, that's when we refer to it as a long term. So when you borrow money and you are using that money to build, that's your warehouse, and the building you are doing goes beyond 1 year, that's a substantial period of time. That warehouse is what we refer to as qualifying asset. Qualifying asset. The word qualifying means asset in the process of becoming an asset. It's like a work in progress. How we value assets that are work in progress in the financial statement as at the reporting date. Because, for instance, you took loan on the 1st January 2022 to build a warehouse, and the house will not be completed, maybe it's a big warehouse, until the end of 2024. That's 3 years. You are obtaining loan to finance the building of that warehouse for the period that the warehouse is being built. And interest is charged on that loan every year. IAS 23 says that interest that is charged on loan should be capitalized as part of the cost of that building. Don't forget, when we treated IAS 16, the first example I treated is that you buy an asset on credit, you are going to pay later. The asset is ready for use on the date of purchase. The interest that is charged on that money you pay later is not going to be the part of the cost of that asset. Why? The asset is ready for use on the date that you bought that asset. It is not a qualifying asset. It's not an asset in the process of getting ready for use. It's an asset that you can start using immediately. For example, plant and machinery or motor vehicle. You buy it on credit or you borrow money to buy it, and that money you borrowed had interest, or when you buy on credit you are paying later, it has interest implication. So the value of that asset will separate that interest from the value of that asset. But now for qualifying asset in the process of becoming an asset, it takes another dimension. And the dimension in this case is that the cost you incur as interest will be capitalized as part of the cost of the asset, because the asset is delaying in getting ready and you are incurring additional expense apart from the direct expenses on building that asset, which is the interest you are paying on the loan you obtain over that period of time. So that's where the concept of IAS 23 borrowing cost is. So we know borrowing cost also means interest, finance charge, or whatever you call it. And we also know qualifying asset is an asset an item of PPE or can be inventory in the process of completion. And we have examples of qualifying assets here. Number one, inventories. Now, when we say inventory, you can see the following are not qualifying assets. Inventories that are manufactured or otherwise produced over a short period of time is not a qualifying asset. And don't forget, in accounting, short period means 1 year. So if it is within a year that you are producing that inventory, it's not a qualifying asset. For inventory that takes more than a year to produce, that goes to 2 years to produce. For example, why we are saying this is because there are companies that are into that. All these companies making aeroplane. Don't forget that if your company is producing aeroplane, that aeroplane is an inventory. Whereas your company might buy a computer, a laptop that is using, that they give to the accountant using the department, that laptop will be what? A PPE, because it's being used. But the aeroplane that you want to sell, producing for sale, is actually what? An inventory. So it is not, when we say difference between PP and inventory is not sometimes about the size of the asset or how much you bought the asset. It's about the purpose of the asset. Is it held for sale in the ordinary course of business? If yes, then it is an inventory. Is it held for use in the production or rendering service? Yes. If the answer is yes, then it is a PPE. That is very, very important in classifying asset and PPE. If, for instance, your company is into construction, you are building houses that you give out, that you rent out, or that you sell, you can have a house that is worth 300 million naira. You can have the one of worth 500 million naira, and it's treated as an inventory. It's an inventory because the purpose of it is because you are holding it to sell it. But the laptop that you bought for like 120,000 naira or 150,000 naira that is being used in the office will be treated as a PPE because it is being used in the production or rendering service in the ordinary course of business. So that's it. So if your inventory takes more than 1 year, like your company is building a ship, you are selling, your company manufactures ship, aeroplane, motor vehicles, it's an inventory, it takes more than a year. That inventory is a qualifying asset because it takes more than 1 year. Then PPE is a qualifying asset. Intangible assets are usually qualifying assets, but we are still going to go to that standard. Maybe after we treat two standards, now we go to IAS 38, talking about intangible assets, because it takes time also to get intangible assets. To build a brand takes time. To get trademark takes time. You can't just wake up one day and you say you are having a trademark, or you are, for instance, you want to have a brand. You have to have been out selling yourself for a long time before you become a brand. And when you become a brand, that's when you become money. Anybody that wants to use your brand will now be paying, not for any tangible asset, but for that fame that you already have, which is an intangible, it cannot be touched, but it is there. Once you put the name, because it has a popularity, once you put it on an item, people will buy it. That's why we call it asset. We'll be learning more about that under IAS 38. So that's what we call qualifying asset. Asset that takes substantial period of time to get ready for its intended use or sale is a qualifying asset. And the concept of this standard is that when you borrow money to produce that kind of asset, that money should be capitalized as part of the cost of the asset. So we say borrowing cost eligible for capitalization. That is the interest that are eligible to be capitalized as part of the cost of the asset is what we are talking about here. So it's a borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset must be capitalized as part of the cost of that asset. All other borrowing costs are recognized as an expense in the period in which they are incurred. If the interest is not on the money you borrow on a qualifying asset, interests are usually written off in the statement of profit or loss for the period. But if it is on the money you borrowed to build a qualifying asset, it should be capitalized as part of the cost of the asset. The borrowing costs that are directly attributed to the acquisition, construction, or production of a qualifying asset are those that would have been avoided if the expenditure on the qualifying asset had not been made. What they are saying is, why do we capitalize those borrowing costs that are directly connected to building the asset? It means we would not have incurred those interest expense if it is not that we are manufacturing the asset. So that's the reason why it will be capitalized. We say this includes the costs associated with specific loans taken to fund the production. That is, you go to Zenith Bank specifically because you want to produce that asset. You approach them for loan. That's what we call specific loan. Or we say, and then we have that is, this includes costs associated with specific loan taken to fund the production of or purchase of an asset, and general borrowings. General borrowings, it means, okay, usually we used to borrow money every year to run our business. But from this money we borrow generally for running our business, part of it is also spent on this qualifying asset. That's what we call general borrowing. Specific loan is the one you took specifically in the name of that asset. General borrowing is the money you borrow generally for running of your business for the year. But part of that money is also invested in constructing a qualifying asset. There is a way we calculate that. That's what we are going to next. So general borrowings are included because if an asset were not being constructed, it stands to reason that there would have been a lower need for cash. That is, this general borrowing that is so plenty that we borrowed this year, we would not have got so much loan like that if not that we are trying to make a qualifying asset. If not that we are trying to make a qualifying asset. So we say funds specifically borrowed to obtain qualifying asset. So say when a specific loan is taken in order to obtain a qualifying asset, the borrowing cost eligible for capitalization are the actual borrowing cost incurred on that borrowing during the period, less any investment income on the temporary investment of those borrowing. Now, this explanation, let me give us this explanation very well. You have gone to the bank, borrow, let's say, 800 million naira, specifically because you are constructing a warehouse. But of course, you borrow that money in 2022, January, for instance. The house will not be completed until, let's say, 2024. That's a qualifying asset. But in 2022, we are not spending all the 800 million naira on that house. Don't forget that the investment, the expense you incur on a qualifying asset will be done in phases. So in 2022, the amount you spend will be different. The remaining one in money management, under strategic financial management, we'll be learning more about that. Those of us who will be writing this in the future, that the money you borrow 800 million, but in 2022 that you borrowed that money is only 200 million you needed that you spent on that building for that year. So you don't want to keep the remaining 600 million in your hand lying fallow, that is a money that is yielding interest, must also be put to investment. So you invest 600 million in 2022 and spend 200 million on the project. That investment may be temporary investment. Temporary investment means this short-term investment that, okay, I can quickly sell it at the end of the year, get money so that I can have money to spend on that project in 2023. So that temporary investment in 2022, the income that comes from that temporary investment. For instance, you borrow 800 million, you spend 200 million, and that 800 million will attract 80,000. Let's just use that, okay, or 800, let's just say, okay, 8 million. Let's say 8 million is the interest that will be on the 800 million in 1 year. Now, you have spent only 200 million on the project. The interest on that 200 million will be what? A fraction of that 200 million, which can say, let's say 2 million naira. That's the interest of the 200 million that you have spent that year. That is the money you have spent. The interest element is 2 million naira. Now you invested the remaining 600 million, and that 600 million attracts 3 million interest at the end of the year. Let me just make it that like that. It has had 3 million interest at the end of the year. We are now saying, okay, the interest that is on the qualifying asset, which is 2 million, minus the interest, the investment income that came from the money you invested. If that interest is more than that investment income, the remaining is what you capitalize. If it is less, that there is nothing to capitalize that year, that you recognize your investment. So let's take an example to explain this properly. Let's take an example to explain this properly. So this example is looking at, on 1 January 2009, Owerri Engineering issued a bond. To issue a bond means you borrow money. That's the debenture note. You sell your bond. That's what they borrowed was issued a bond to raise 25 million naira to fund a capital project, which will take 3 years to complete. It will take 3 years to complete. Amounts not yet needed for the project are invested on the temporary basis. During the year to 31st December 20X9, that is, we are accounting for that year that we borrowed the money. Borrowed on the 31st December 20X9, Owerri Engineering spent 9 million naira on the project. Only 9 million out of 25 million is spent. The cost of servicing the bond was 1,250,000. That is the interest during this period. And the company was able to earn 780,000 naira through the temporary investment of the amount. The requirement will be what? How much should we capitalize? I need to put the requirement here also. Just 1 minute. Required. How much is the value of this qualifying asset as at 31 December 20X9. How much is the value of the asset as at 31 December 20X9? That's the requirement. That's what we want to work on. So that's the required. How much is the value of this qualifying asset as at 31st December 20X9? So let's quickly open a worksheet to do that. I will call that example 3. And so we are on what? IAS 23. Borrowing cost. Borrowing cost. So we are looking at borrowing cost, and then we are seeing, we want to treat this example on how to treat that question. So let me bolden this. So the first thing we need to look at is how much was borrowed? 25 million. How much was spent? 9 million naira. Out of how much borrowed? The interest for that year is what? The cost of servicing the bond was this for that year, 1,250. That's 1,250,000. and the income from investment is this amount. So when we want to determine the value, the question is that we should determine the value of the qualifying asset as at the end of the period, the value. So the qualifying asset is what we want to determine the value. So let me put the Naira sign here. So say value of qualifying asset, value of the qualifying asset. Value of the qualifying asset is what we want to determine. So amount spent on the asset during the period. Amount spent on the asset. Amount spent on the asset. Okay, let me put here. Value of the qualifying asset on 31/12/20X9. Let's put that date there. It is important so that we exactly know which date we are actually computing for. So the amount spent during the period is what? Based on the question, the amount spent is what? 9 million naira. So here we have 9. Let me round this to the nearest million so that we don't have plenty zero in our nearest thousand, sorry. So to now 9,000. The amount spent is that 9,000. Now, the amount of interest that the thing attracts for the year is what? 1,250,000. So borrowing cost is what? 1,250,000. Okay, sorry, I've rounded it up to the nearest thousand, so it's going to be this amount. But we are going to less the what? The investment income. The investment income, which is what? 780,000. Less investment income. Less investment income. Let me just shorten it like that. Investment income, which is what? 780,000. So I put 780 here. 780. I put 780 here. That's going to be what? In jacket. 780. So the sum of all these, you can present it differently like this, putting this one in a separate box and putting the borrowing cost to be capitalized borrowing cost. Capitalized borrowing cost, that is how much to be capitalized, is the difference between these two. We put it there, the difference between these two. This is the amount to be capitalized as the borrowing cost for the period. The amount to be capitalized as borrowing cost for the period. So the value of the asset will now be what? Value of the asset in the financial statement will now be what? The addition of the direct amount spent and the amount to be capitalized. That will be what? 9,470,000 naira. That is how to calculate the value of the qualifying asset at the end of the period. The entire interest minus the income that came from the temporary investment of the remaining one, we see the interest that we have to capitalize. That's the interest we are going to have to be part of the direct cost to determine how much this asset will be stated in the balance sheet as at the end of 20X9. I hope we understand this example. Or you have a question, quickly address that, because we'll treat one more example before it is 7 o'clock that we close. You have a question? Please. If you have a question, put it there in the chat. If you have no question, just say okay. So I'll move on to the next example. That's how to determine the amount to be capitalized when you are having that borrowing cost. Please, I'm waiting for response. If there's no question, just say okay, so that I'll know that you can hear me, and that I can move on. Okay, okay. Mr. David, what about you? Are you okay? No, I'll move on with that. Waiting for him, he's typing. Let's see. He has a question. I'm not fine again. I'm preparing for church. Okay, I understand. Don't worry, you watch the video later. In 15 minutes or 12 minutes, we should be done because everybody will also have to prepare for church. So that's on that borrowing cost. Next, we talk about general funds used for the purpose of obtaining a qualifying asset. Now, that one we treated is a specific loan. They took this money for the purpose of this project. So we are looking at when they borrow general money, how do we do it? When general borrowings are used, the amount of borrowing cost eligible for capitalization is obtained by applying the capitalization rate to the expenditure on that asset. Applying a capitalization rate to the expenditure of that asset. The capitalization rate is the weighted average of the borrowing cost applicable to the borrowing that are outstanding during the period, except for borrowings made specifically for the purpose of obtaining a qualifying asset. The amount of borrowing cost capitalized cannot exceed the amount of the borrowing cost it incurred during a period. So what we are trying to say now is that when you borrow money generally to run business and you spend part of that money on the borrowing cost, interest on that general borrowing, part of it will be applied to the amount spent on the project. But to know which part of how much of it will be applied, we need to use what we call the capitalization rate. So we have an example. General borrowing, talking about capitalization rate. The Shaki Construction has three sources of borrowing. 7-year loan. The amount of the loan is 8 million naira. Interest expense on that 7-year loan is 800,000. 10-year loan, which is 10 million naira. Interest expense incurred is 900,000. Bank overdraft, which is 5 billion naira. Interest on it is 900,000. The 7-year loan has been specifically raised to fund the building. So what that means is that the interest on that 7 million naira loan is a specific loan. It will be capitalized. So the general loans in this question will be the 10-year loan and the bank overdraft. They are the general loans, 10-year loan and the bank overdraft. So it is on those two that are going to be computing what we call the capitalization rate, because the requirement is that we should determine the capitalization rate. So quickly let me do that in this place. So example 4. Example 4. And for this example 4, we have what we call, we want to the thing we want to do this one, we want to do the capitalization rate. Capitalization rate. That's what we want to treat under this example. Capitalization rate. And so this capitalization rate is what we want to determine here. Now, don't forget this 7-year loan that is specifically borrowed will not be tampered with under this capitalization rate. It is the general borrowing that gives rise to capitalization rate. So we are going to be having the loan, the general borrowings, general borrowings. the general borrowings during the period. And let's put the Naira sign here. The general borrowings during the period and the interest on them. General borrowings and the interest on them. So the first general borrowing here is what? The 10-year loan. So we come here and say 10-year 10-year loan. 10-year loan. How much is the 10-year loan? 10 million naira. 10 million naira. Since we have rounded this to 9,000, we just put 10,000 naira here. Just put 10,000 naira here. And then, how much is the interest? Okay, I need to have put, let me do it this way, so that we know which column. This is the loan, while this is for interest. So the interest on the loan is how much? 900,000 naira. So we come here and say 900. Since I've rounded to the nearest thousand, we also have 900,000. And then we have the overdraft. The overdraft, the value of the overdraft is 5 million. The interest is also 900,000. So overdraft 5 million, which is 5,000 because I've rounded it. Overdraft is 5 million, and the interest on it also is 900,000. 900,000. 900,000. That's the interest on it. We want to determine what we call the capitalization rate. So this is how to do it. We add the loans together. The loan is 15 million naira. That's the loan. And then we add the interest together. The interest is 1.8 million naira. The formula for capitalization rate. The formula for capitalization rate. So capitalization rate formula. Capitalization rate. The formula for capitalization rate is what? It's going to be the interest divided by the loan. So the formula is what? Capitalization rate equals interest divided by loan. That's the capitalization rate. That's the formula for capitalization rate. So let me put that there so that we know exactly what we are doing. That's the difference. So if I want to calculate the capitalization rate now, it's now going to be what? So the rate capitalization rate will now be the interest. No, sorry. Capitalization rate will now be, the formula will now be the interest, which is how much? 1.5 million divided by the loan, which is 15 million. And so what is the answer? The answer will be the capitalization rate equals 1.5 million, 1500 divided by the 15 million. The capitalization rate here, let me do it again. Sorry, this is 1.8, not 1.5. I said 1.5, it's 1.8. 1.8 million. So capitalization is what? 1.8 divided by 15 million. So it is 12%. Let me say times 100 so that we can have it there. Times 100. So the capitalization rate is 12%. 12%. 12%. That's capitalization rate. It's 12%. It's 12%. So that's the first requirement they ask us here is how to compute capitalization rate, 12%. Now, the latter part of it, in the next 5 minutes, I should be done. The later part of it, the question now went further. We have answered this question now by determining the capitalization rate, which is what? Interest divided by the loan. That is the interest from the general borrowing divided by the general borrowing. Don't forget, we are dealing with only these two as the general borrowing for the period. We are dealing with only these two as general borrowing for the period. Since they said the third one, which is 7-year loan, is a specific loan. It's not going to be used for calculating capitalization rate. So the question went further to say, continue the example above, Shaki Consortium has incurred the following expenditure on a project funded from general borrowing for the year ended 31st December 20X9. That is, from the general borrowing on 31st March, he incurred 1 million. On 31st July, he incurred 1.2 million. On 30th October, he incurred 20,000. Require how much of the general borrowing cost? How much of the general borrowing cost should be capitalized? How much of the general borrowing cost should be capitalized in 20X9? So we are going to be looking at that. Borrowing cost to be capitalized. That's example 5. Example 5. Example 5. Example 5. So we want to know the borrowing cost to be capitalized, the general borrowing cost. General borrowing cost to be capitalized. General borrowing cost to be capitalized. General borrowing cost to be capitalized is what we are looking at now. The general borrowing cost to be capitalized is what we are looking at now. General borrowing cost to be capitalized. So now let's copy the Naira amount and the interest. So the question says on 31st March, so I'm going to put the date here. Let me put date here. Date. On 31st March, that's 31/3/X9. X9. That's the date. On 31st March 20X9, that is that year, he incurred the amount of 1 million naira. 1 million naira. So 1 million naira. Okay, let me do it this way. I need to put the difference between the loan amount and then the interest is what we want to calculate. Interest. And the formula for computing this interest is what? The amount borrowed, interest equals loan spent times capitalization rate. That is the loan that the person borrowed times the capitalization rate. That's the formula for calculating this interest. So how much is the loan spent in March 20X3? 1 million naira. So put 1 million naira here. 1,000. Since we've rounded it. On which date again? 31st July. 1.2 million. So 31/7/X9, 1.2 million. That's 1200. Since we have rounded it. And the last one says on 30th October, that is 3/10. 30th October, 30/10/X9. How much is that money again? 800,000. 800,000. 800,000. 800,000. That's I have rounded it, so just 800,000. Now, we want to calculate the interest on each. The interest on this will be calculated, multiplied by the capitalization rate, which we have already arrived at here, which is 12%. I need to put it somewhere here. The rate is what? 12%. Rate. Capitalization rate is 12%. 12%. Then put it 12%. 12%. That's it. So the formula here will now be, we are going to be multiplying this 1 million times the 12%. Then we will prorate to the number of months. This was incurred on 31st March. So it's going to be for 9 months during the year, times 9 divided by 12. That's the interest. Interest here is this amount. That's interest in this place. The interest here. That's interest incurred in this year here. That's interest incurred in this year here. Let me drag this down. The interest incurred here. Then for this also we do it. Equals 1.2 million times the capitalization rate times how many months? This 31st July. So August, September, October, November, these are 5 months times 5 divided by 12. So that one is 60. We all come here and say 800,000 times the capitalization rate, which is 12,000, times how many months? This is 30th October. So it means it's only for November and December, 2 months, times 2 divided by 12. So that's it. The capitalization rate is this. So the amount to be capitalized will be the sum of these, the interest on loan for the period. That's it. That's how to calculate that on borrowing cost. So interest, this borrowing cost, capitalized. Borrowing cost capitalized is this amount of money for the period. So that's how to calculate borrowing cost. I hope we are able to get that. That is on borrowing cost for the period. Maybe in the next class, I will conclude on borrowing cost by giving us other explanations that we need on it. When should it start? When should it cease? And then, okay, it's in the notes here. Cessation of capitalization. Capitalization of borrowing cost should start only when expenditure for the assets has been incurred, borrowing costs are being incurred, and the activities necessary to prepare the asset have started. You can see that's when you commence. You have incurred the expenses on the expenditure on the asset. You have spent money on the asset. You have also attracted interest, and you have started building. You have started building the assets. You start calculating borrowing cost. Suspension of capitalization. Capitalization of borrowing cost. Capitalization of borrowing cost should be suspended if development of the asset is suspended for an extended period of time. So if it takes time for you to develop the asset, you have to, if it takes time, you have suspended it, that is, you stop building for a substantial period of time, that is more than 1 year. More than 1 year, you stop building, you have to suspend capitalization. Then cessation of capitalization. Capitalization of borrowing cost should cease when the asset is substantially complete. You can't capitalize interest again when you have completed it. The costs that have already been capitalized remain as part of the asset cost, but no additional borrowing cost may be capitalized again. You can't capitalize again after you have completed the asset. So that brings us to the end of the class. So please, let's call it a day because of church. Yes, I'm calling it a day now. Thank you very much. So thank you for your time. The video is also there, and this is the last part on capitalization. So if you have questions, can send it to me whenever you watch it after the class. So thank you for your time. I believe that you enjoyed today's class, and we will continue next week. Thank you very much.